You might be hearing more about bonds in the news these days. That's because it's been historically common for investors to flock to bonds when the economy is rocky. But why? Well, there are several reasons. Number one, the basic anatomy of a bond. Bonds tend to have a predictable and fixed set of scheduled payments called coupon payments or coupons, and a maturity end date where you receive your initial investment when the bond expires. Here's the thing. When uncertainty arises, predictability can become more appealing to investors. Remember, stocks have less predictability and even dividends can be suspended at any moment. Number two, how bonds react to interest rates. Investors are always looking to maximize returns, which means comparing potential returns across various assets. When a higher interest rate comes into effect, newly issued bonds are structured to have a higher coupon and yield to reflect these higher rates, and are seen as more attractive to hold. At the same time, a sell-off on existing bonds occurs. A rate rise negatively impacts the market price of existing bonds while raising its yield, which is the coupon payment as a percentage of the market price. Why do existing bonds suffer a price decline? The yields on already issued bonds are no longer as competitive, but the sell-off ultimately balances out the relative attractiveness of existing bonds by decreasing price and increasing yield until they match those that exist in the new rate environment. Number three, bonds can be backed by governments and are typically less volatile than stocks. And bonds that are backed by a government means default risk or failing to make your payments can be lower. In fact, US Treasuries have never defaulted historically. This makes for a strong reason to consider bonds, especially when risk is high. Remember, assets like stock can go to zero. So, government-backed assets that all but guarantee a return can make for an attractive investment. In fact, bonds have historically protected investors in challenging markets. This data compares the price decline of various asset classes during the worst 10% of market-performing months over a 30-year period in recent history. It tells us that bonds have fared much better than other assets during challenging markets. We can see on the right that bonds experienced positive returns, while on the left, other assets experienced steep declines. While bond popularity has fluctuated throughout history, the data indicates plenty of investors could potentially benefit from exposure to bonds. Have more questions? Check out the links to the right and in the description below.